Hello, I am Pankaj Agarwal from BCom first semester and I am excited to be with you today to discuss the dynamic and vital topic of financial services. I look forward to sharing insights and perspectives that shed light on the details of this crucial aspect of our economic world. So let's start. In this presentation, I will be explaining about the introduction of financial services, its elements, its constituents, its features, and its emerging financial services. So let's start it with the introduction of financial services. It refers to a broad range of economic services provided by the finance industry, including banking, investment, insurance, and other related activities that manage and optimize monetary transactions and assets. Financial services encompass activities such as banking, lending, investment management, and insurance, and various other financial transactions. These services plays a very crucial role in facilitating the flow of economy, supporting individuals, businesses, and government in managing their financial affairs. Also, financial services includes three major elements which are instruments, market players, and regulatory bodies. So let's explain each one of them one by one. Instruments include the public issue of shares, debentures, convertible debentures, fixed deposit certificates, etc. Market players. It includes the bank, financial institution, mutual funds, stockbrokers, etc. This includes not only those who are directly involved in the process, but various intermediaries such as advisors and consultants, underwriters, sponsors, market makers, etc. Number 3. Regulatory bodies and specialized institutions. It includes the SEBI, which is known as Securities Exchange Board of India, State Stock Exchange, Credit Rating Services, Discount and Finance House of India, Stock Holding Corporation of India Limited, and OTC of India and venture capital companies. Coming to the constituents of financial services, it includes government. The central government is one of the most important constituents of the financial service sector because of its regulating power. It has extensive powers under the Companies Act 1956, Capital Issue Control Act 1947, and the Securities Contracts Regulation Act 1956, and other constituents are mutual funds, stockbrokers, stock exchanges, financial consultants, non-banking financial institutions, banks, other consultants, merchant bankers, portfolio services, regulatory services. Turning our attention to the features of financial services. So, number one feature is diversity. Diversity. Financial services cover a wide range of activities including banking, investment, insurance, and more, offering a diverse set of options to meet various financial needs. Number two, customization. Many financial services can be tailored to individuals or businesses' requirement, allowing for personalized solution based on specific financial goals and circumstances. Number 3. Intermediary role. Financial institutions often act as intermediaries, connecting savers with borrowers and facilitating the efficient flow of funds within the economy. Risk management. Financial services provide tools and strategies for managing financial risk, helping individuals and businesses protect against uncertainties. Number 5. Innovation. The financial services sector continually evolves, incorporating technological advancements and innovations and leading to the development of new products and services. Let's shift our focus to the importance of financial services. Number 1. Economic growth. Financial services plays a crucial role in fostering economic development by facilitating capital formation, investments, and entrepreneurship, contributing to overall economic growth. Number 2. Wealth creation. Through investment and asset management services, financial institutions contribute to the creation and growth of wealth for individuals and organizations. Number 3. Financial inclusion. Financial services aim to provide access to banking and other financial tools to a broader population, promoting financial inclusion and reducing economic disparities. Number 4. Resource allocation. Financial institutions help allocate resources efficiently by channeling funds from savers to borrowers, ensuring that capital is directed towards productive and profitable ventures. Number 5. Risk mitigation. Insurance services provided by the financial sector mitigate financial risk, offering protection against unexpected events and helping in the recovery from losses. Now, addressing the emerging financial services, we can classify financial services into non-fund based activities, fund based activities. Non-fund based activities are merchant banking, portfolio management, industrial consultancy, broking, etc. Fund based activities are hire purchase, consumer financing, and real estate financing. Exploring non-fund based activities in detail. Firstly, we have merchant banking. Merchant banks are financial intermediaries. They act as intermediaries for transfer of capital from those who own it to those who use it. Merchant bankers provide assistance to the corporate house for setting up industries. On the second slide, we have hire purchase financing. Hire purchase financing is a form of credit finance where goods are supplied after payment of a deposit with an agreement to pay regular installments over a period of time. At the end of hiring period, legal title passes to the hirer on payment of a nominal sum. On the third slide, we have leasing. Leasing in the recent times, leasing has emerged as an alternative mode for funding of fixed assets. Many banks, financial institutions, as well as leasing and financial companies are engaged in the business of financing or booking for leasing. This medium provides a good means of modernization and diversification to the small and medium industries. Entrepreneurs, businessmen not having adequate funds to buy assets required for this business. On the fourth slide, we have housing finance. Another emerging concept in the field of finance is the providing of finance for construction of houses. Companies like Housing Development Finance Corporation, State Cooperative Housing Finance Societies, Bank, Life Insurance Corporation, Housing and Urban Development Corporation have devised different schemes under which finance is provided for construction of houses both by the individuals as well as cooperative group housing societies. On the fifth slide, we have venture capital. Venture capital. The term venture capital represents financial investment in a highly risky project with the objective of earning a high rate of return. While the concept of venture capital is very old, the recent liberalization policy of the government appears to have given a support to the venture capital movement in India. In the real sense, venture capital financing is one of the most recent entrants in the Indian financial market. Venture capital financing involves a high degree of risk. So let's come on the sixth slide. We have portfolio services. A new area in which financial services are rendered is portfolio services, that is, managing the portfolios of individual clients. SBI Personal Banking Centers and VCS Bank Investors Clubs are two good examples. There are also a few private investments advisors who guide and help individual investors manage their portfolio. So let's come to the next slide. We have bill discounting. Bill discounting service provides finance to the supplier of goods against invoice. It's the customer does not pay on the due date, the financing agency collects the dues from the supplier in case of bill financing. On the next slide, we have credit rating. Credit rating is the assessment of a borrower's credit quality. Credit rating performs the function of credit risk evaluation reflecting the borrower's expected capability to repay the debt as per terms of issue. Credit rating is merely an indicator of the current opinion of the relative capacity of a borrowing entity to service its debt obligation within a specified time period and with particular reference to the debt instrument being rated. So Now we have mutual funds. With the issue of master shares in 1986 by the Unit Trust of India, the mutual funds found emergence. This helped small investors reluctant of investing in securities to pay up their savings to the manager of funds, who were specialists in the field to gauge the market and make investment in new issues after an assessment of the viability thereof. Now, in the next slide, we have factoring. A comparatively new concept in India is a financial service under which the factor undertakes to collect their client's debt and finances on the basis of accounts receivable, which arise as a result of credit sales to the buyer by the sellers. The factor collects the services charged by way of discount or rebated deducted from the bills. Through this concept owes its origin to the advanced countries, it can serve as an important function in India too. Here we come to the end of our video. To end in a strong note, I would like to say that these financial services play a crucial role in facilitating the flow of money capital within the economic, supporting individuals, businesses, and governments in managing their financial affairs. Thank you, everyone.